This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of January 2026, and I think it's fair to say that the Singapore equities market ecosystem is kicking off this brand new year with a sense of cautious optimism, not least because many of the recommendations of the Equities Market Review Group that the Monetary Authority of Singapore formed in 2024 to revitalize the local market are going to kick in over the coming months. So, even though Singapore stocks have risen significantly over the past year, with the Straits Times Index making new all-time highs in the face of global economic and geopolitical uncertainties, there is still a sense of anticipation in the local market that the review group's recommendations may soon make things even better. For instance, the dual listing bridge announced by the Singapore Exchange and Nasdaq back in November, which will allow companies with market capitalizations of $2 billion and above to simultaneously list on the two exchanges with a single prospectus, probably won't be implemented until sometime in the middle of this year. Meanwhile, the Equity Market Development Program, which will see MAS distribute $5 billion to fund managers with a strong focus on Singapore stocks, is still in the process of being rolled out. In November, when MAS put out the review group's final report, it announced that a further $2.85 billion would be allocated to 6 fund managers under the EQDP. Together with the $1.1 billion placed with the first batch of 3 fund managers, which had been announced earlier, a total of $3.95 billion has been farmed out across 9 fund managers. As these funds are deployed by the fund managers, and as MAS distributes the remaining $1.05 billion of EQDP money, there is a great deal of anticipation that Singapore-listed companies will be more incentivized to unlock value and boost their financial performance. So there is this broad undertone of optimism out there, regardless of all the concerns about global macroeconomic and geopolitical uncertainty. Now, I'll talk more about the STI's strong gains and offer some views on how investors ought to position themselves to ride the Singapore market in 2026 later in this podcast. But let me first get into the topic of the SGX-Nasdaq dual listing bridge that I mentioned a moment ago, and some of the other so-called supply-side initiatives to draw more high-quality listings to the Singapore market. The fundamental reason MAS formed the Equities Market Review Group in 2024 was not just to boost Singapore stock prices. Its purpose was really to enhance Singapore's standing as a vibrant enterprise and financial hub. There was a realization, in my view, that the Singapore stock market had become a weak link of sorts in the startup ecosystem, and that successful Singapore startups were not going to list in Singapore unless something was done to make it more attractive to do so. Koh Boon Hui, the chairman of the Singapore Exchange, alluded to this in the group's last 2 annual reports. In its June 2024 annual report, the SGX chairman warned that venture capital and private equity investors need liquidity events to recycle the capital that they deploy, failing which the supply of such capital will eventually dry up. In the exchange's June 2025 annual report, he mentioned that there were nearly 14,000 startups backed by VCs across Southeast Asia, and while many of them may not succeed, hundreds of them will grow and mature and eventually seek to return capital to investors. He went on to say that if the best of these companies choose to list elsewhere, the entire value chain of investment bankers, corporate lawyers, and accountants would eventually follow them, and Singapore would be left worse off. So the national effort to revive the Singapore market was not just about getting stock prices up. It's also about drawing more new listings to the Singapore market and creating high-value jobs in the financial sector, which is a very important part of the Singapore economy. But here's the thing. MAS has introduced specific measures over the years to make it easier and cheaper for companies to list in Singapore. For example, it tried offering grants to directly defray the cost of seeking a listing. It also tried providing incentives to produce more research on locally listed companies and subsidies for research houses to develop their analyst talent. MAS also unveiled, back in 2021, the Anchor Fund at 65 to support promising high-growth enterprises and market leaders as they sought listings in Singapore, including secondary and dual listings. The Anchor Fund is managed by 65 Equity Partners, which is a unit of Temasek, and it has backed some of the companies that were recently listed in Singapore. For instance, among its portfolio companies is AvePoint, a software provider that helps organizations manage their data. AvePoint listed on Nasdaq in 2021 by combining itself with a publicly traded special purpose acquisition company, and it obtained a secondary listing in Singapore in September 2025. Another of the Anchor Fund's portfolio companies is Ultra Green AI, a medical technology player specializing in fluorescence-guided surgery, which just began trading in Singapore in December. But these measures haven't changed the big picture. The reality is that the US market has been, and still is, an overwhelmingly powerful magnet for global capital. As a result, even companies that are better known in Asia than they are in the US, such as Grab and Sea, have chosen to list there in order to obtain the best possible valuation for their shares at IPO. And listing in the US hasn't really denied these companies access to capital in Asia because capital is increasingly mobile. Singapore, for instance, has enormous national savings under the stewardship of GIC and Temasek. But these institutions conduct their investment activities all over the world on purely commercial terms, and rightly so. In fact, the government shot down calls last year for GIC to invest its funds in locally listed stocks to help restore the vibrancy of the Singapore market. The government also made it very clear that Temasek-backed companies should not be forced to list in Singapore when they decide to go public. Instead, they should be allowed to list wherever it makes the most commercial sense. So, how can Singapore possibly compete with the US market? Well, this is where the SGX-Nasdaq dual listing bridge comes in. US-listed companies with an Asian nexus have always been able to seek secondary listings in this region to widen their investor following. But doing so involves time and money and may not be an especially high priority for many of them, especially since capital is quite mobile these days. The dual listing bridge that SGX and Nasdaq have announced could be a game changer because it seeks to offer companies with market caps of $2 billion or more the opportunity to list on both exchanges when they decide to go public without much additional cost or effort. Most importantly, companies will only have to submit one prospectus to obtain listings on the two exchanges. On the face of it, it seems to be an attractive proposition for Asian companies that are already eyeing a Nasdaq listing. They would be able to secure a strong valuation in the US market while also tapping investors in Singapore without much additional cost or effort. That's the aim anyway. This could pave the way for GIC and Temasek to play a bigger role in fostering an institutional asset management ecosystem in Singapore that includes the local stock market while adhering to their commercial principles. After all, if promising Asian companies seeking a listing on Nasdaq also see fit to have a dual listing in Singapore, these institutions would be able to support those companies via the Singapore market. When the dual listing bridge was announced in November, MAS specifically said the EQDP, as well as the Anchor Fund, will support fundraising and trading liquidity for companies on the new Global Listing Board, which is the board for the SGX-Nasdaq dual listings. The joint announcement from SGX and Nasdaq on this initiative also included a statement from Temasek welcoming the move. Temasek said the initiative complements the work of its asset management platforms such as Seviora, 65 Equity Partners, Heliconia, and Vertex in contributing to building the Singapore ecosystem and enabling promising enterprises in the US and Singapore to scale across markets. But will it really be possible for companies to dual list on SGX and Nasdaq as easily as seeking a listing on Nasdaq alone? And would growth-oriented companies that avail themselves of the SGX-Nasdaq dual listing bridge garner strong support from Singapore's famously dividend-focused investors? What does it all mean for investors in the Singapore market? I'm going to talk about that next.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Market, a podcast of BT Correspondents.
With the Equity Market Review Group actively making recommendations over the past year, the market's reception to every new main board listing recently has felt like a referendum of sorts on whether enough has actually been done to get the Singapore market back on track. And unfortunately, the results haven't really been all that great. Now, I'm just talking about primary main board listings here because they tend to get the most attention, and some of them, such as Infotech Systems and NTT-DC REIT and Ultra Green, have a strong technology flavor and are the sorts of companies that SGX really wants to attract. Yet, the only main board IPO last year that has delivered really strong post-listing performance was Centurion Accommodation REIT, which is trading more than 20% above its IPO price right now. Soon Hock Enterprise, which is an industrial property company, is about 8 or 9% above its IPO price. And Yangzijang Maritime Development, which was spun out of Yangzijang Financial, is trading about 10% above the price of a placement that was done in conjunction with its listing. But really, the rest of them, Infotech Systems, NTT-DC REIT, even Collywood, which is the co-listing property arm of LHN, are all trading underwater right now. Most disappointingly, perhaps, Ultra Green, which in my view is the most interesting of the recent crop of IPOs, also quickly fell below its IPO price within a few days. This company seemed to have a quality that all listed companies ought to have, especially when they first go public. That quality is its uniqueness. Ultra Green describes itself as a global leader in the fluorescence-guided surgery space. In a nutshell, the company sells a fluorescent green dye, along with special cameras and the necessary software that light up perfusions in the human body on a screen during surgical procedures. This enables surgeons to operate with higher precision, which leads to better outcomes for patients. Ultra Green says it has a dominant position in the supply of the fluorescent green dye. It also says that the fluorescence-guided surgery field is growing fast. In my view, that's exciting. Lots of things can go wrong, of course. It could fail on execution. It could be overtaken by some superior technology. But at the outset, there is a clear investment story here. Another interesting aspect of this company's IPO is that it seems to have the support of some well-known investors and business personalities. As I mentioned earlier, this is one of the Anchor Fund's portfolio companies, so the Anchor Fund has a stake in it. Kwah Chong Sing, who's the chairman of the company, was also a pre-IPO investor. Mr. Kwah is a very well-known business personality, of course. He once ran ExxonMobil Asia Pacific, and he has served on boards of many locally listed companies. In fact, he was once chairman of SGX. Meanwhile, another well-known personality, Xiafu Hua, who was once CEO of SGX, is also now on Ultra Green's board as its lead independent director. Yet, despite all these factors, Ultra Green has not managed to stay above its IPO price. The company's IPO was priced at $1.45 per share, that's US dollars, and that valued the company at roughly 31 times its annualized earnings for the first half of 2025. Would it have been better for Ultra Green to have waited for the SGX-Nasdaq dual listing bridge to go live? Well, that might have been risky. Coming up with the regulatory framework to allow the use of a single set of offering documents for a dual listing on SGX and Nasdaq is not a simple matter, and it remains to be seen whether any sticking points emerge along the way, and whether SGX and MAS will be able to adequately address them, and how long all of this will take. Also, it isn't clear whether market conditions in the months ahead will be conducive for IPOs. In fact, it's remarkable, in my view, that the markets have held up as well as they did in 2025 in the face of the US trade tariffs and geopolitical tensions and increasingly stretched stock valuations. So Ultra Green may well have done the right thing by just pushing ahead with its listing. As for why Ultra Green and some of the other recent high-profile new listings in Singapore are trading underwater, this is something that the Mark-to-Market column has reflected on over the last few months. The fact is, there were lots of different potential reasons for each of them. One common factor with all of them, however, was that they had come to market when many well-known companies that had been listed for a long time and that had pretty depressed share prices for a long time were delivering very strong performance through value unlocking and business transformation initiatives and a general improvement in their underlying profitability. Now, I've talked about this and written about this before, so I won't go into great detail. But if you simply look at the 30 components of the Straits Times Index and look at the best performers over the past year, you will know right away what's been driving their shares higher. For example, DBS had delivered a total return of nearly 34% by the middle of December, with promises to keep pushing its dividend payouts higher, following a big improvement in profitability over the past 3 years. Singtel had a total return of nearly 58% by the middle of December, again as a result of a program to deliver higher dividend payouts as it monetizes some of its assets and works to expand its profitability. And it's not just the Temasek-linked companies that have been running. Hong Kong Land delivered a total return of 69% in 2025 up to the middle of December, as it executes on its plan to pivot towards fund management and focus more narrowly on ultra-premium integrated commercial properties in Asia's gateway cities. Driven by such strong performance of these and other heavyweight companies, the Straits Times Index chalked up a total return of more than 27% in 2025 up to the middle of December. As we get into 2026, judging from the mood in the market, it seems to me that more companies will continue trying to deliver shareholder value, while investors reward them for doing so. Indeed, the Equities Market Review Group has recommended measures to promote this behavior. In November, MAS announced a Value Unlock program, which will see it provide $30 million in grants to help companies build competencies in corporate strategy, capital optimization, and investor relations. This could help small and mid-sized companies with depressed share prices drive shareholder value more effectively. So the way I see it, investors in Singapore ought to position themselves in 2026 not just by looking at valuations and dividend yields, but on the basis of a company's stated plans and its capacity to deliver shareholder value. This brings me back to the national effort to draw more high-quality listings to the Singapore market. I used to think that promising companies would naturally be drawn to list in Singapore as the market climbed and as investors became more bullish. Yet it's possible that the strong gains charted by many of the prominent constituents of the STI over the past couple of years might have, to some extent, drawn attention away from some of the newly listed companies. For instance, the very same day that Ultra Green began trading, DFI Retail Group, which is a component of the STI, held its inaugural Investor Day, where it unveiled a number of strategic initiatives to boost its earnings and a new dividend policy based on a 70% payout ratio, up from the previous 60% payout guidance. DFI retail shares, which had been performing quite well at that point, soared even more right after that. For that week alone, its shares were up more than 19%. With such strong gains to be had from a well-known company like DFI Retail, is it any wonder that investors aren't all that interested in a less established company like Ultra Green with shares that might have been fully priced at its IPO? Now, I'm not in any way suggesting that there's no hope for these recent IPOs. On the contrary, perhaps Ultra Green, as well as some of the other recently listed companies that are trading underwater, just need to bide their time and take a leaf from the book of some of the best performing components of the STI by clearly communicating their plans to drive shareholder value and work to deliver results. If they do that successfully, 2026 may be a better year for them, as well as the whole local IPO scene. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening, and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.